How do Roth IRA withdrawals affect your taxes? Have you ever wondered how your withdrawals from a Roth individual retirement account might impact your taxes? Understanding this can help you make smarter financial decisions. Let's break it down into simple terms. First, it is important to know the difference between your contributions and your earnings. You can take out the money you put into your Roth individual retirement account at any time without paying taxes or penalties. This is because you already paid taxes on that money before you contributed it. Now let's talk about earnings. These are the profits your investments make over time. If you want to withdraw your earnings, different rules apply. To avoid taxes and penalties on your earnings, you need to meet two key conditions. First, you must have owned the Roth individual retirement account for at least 5 years. This is known as the 5-year rule. Second, you need to be at least 59.5 years old, or your withdrawal must be for a specific reason. These reasons include buying your first home, being totally and permanently disabled, or in the event of your death, where beneficiaries can withdraw funds. If you withdraw your earnings before you reach 59.5 years old and before the 5-year period is up, you might face ordinary income tax and a 10% early withdrawal penalty on those earnings. However, there are exceptions to this penalty. For example, if you have qualified education expenses, certain medical costs, or if you have recently had a child or adopted, you may avoid the penalty. When you take money out of your Roth individual retirement account, the Internal Revenue Service has a specific order for how they treat these withdrawals. First, you take out your contributions, which are always tax-free. Then, if you have made conversions, those come next, but only after their own 5-year aging period. Finally, if you withdraw earnings, that is where the tax rules apply. It is also important to report your withdrawals correctly. You will need to use Internal Revenue Service Form 8606 to track your contributions, conversions, and earnings. This helps determine if any part of your withdrawal is taxable. For Asian American taxpayers, understanding these rules can help avoid unexpected taxes or penalties. Since Roth individual retirement accounts grow tax-free and qualified withdrawals are also tax-free, they can be a great tool for retirement planning. If you think you might be in a higher tax bracket later, this can be especially beneficial. If you need to access funds early, remember that your contributions can be withdrawn anytime without tax or penalty, giving you some flexibility. Keeping detailed records of your contributions and conversions is essential to ensure you meet the 5-year rule and avoid unnecessary taxes. If you inherit a Roth individual retirement account, be aware that different tax rules may apply based on when the original owner opened the account. In summary, your contributions to a Roth individual retirement account do not affect your taxes when withdrawn, but earnings can be taxable and penalized unless specific conditions are met. Careful planning and record keeping can help you optimize your tax outcomes with Roth individual retirement accounts.